morning. You're watching The Market right here on ET Now with me, Aisha Faridi, as well as Tanveer Gill right here in Mumbai, and Nikunj Dalmia and Siddharth Bhamre joining in from our Delhi News Centre. And what a day it turned out to be, and I shudder to think what a day it's going to be with the news flow only getting murkier now on PNB. It's now taken a much political angle as well, if I can call it that, with 18 employees now being handed over the pink slips. Seems like there's going to be more to follow, and given the kind of damage that not just PNB in particular but PSU banks have seen from the recapitalization highs, though Nikunj, when it comes to the global setup, seems like the risk off is now waning, given how the US equities have been panning out day after day. The fact that US equities have for a fifth consecutive session posted a green take and a good 8% off the recent lows for Dow.
Asha, depending on who you're asking, you'll get a different answer, trust me. Look at the contrast we've seen in the month of Feb. We've seen US markets have registered their biggest weekly decline since 2008. If I talk about that headline in isolation, then it's clearly gloom and doom. But the second big news point is that US markets also have appreciated for 5 days on the trot now. And this is the 5-day appreciation or price rise since 2011. So really depending on which side of trade you are on, I guess you will have a different kind of a narrative to speak and different kind of a market opinion. But this has turned out to be a very, volatile, choppy, unpredictable kind of an, global market action. Now, there are two reasons why markets normally correct, Asha. First, you have a panic attack where the market shakes out, you see a sharp drop and then a very sharp recovery. And then markets, they pretty much, even out. So is this a panic attack or genuine risk aversion? Typically what happens in a risk aversion, Aisha, is that, asset prices, they go down and they remain low for a long time. But if price pattern is anything to go by, it appears to me that what we've seen in US markets was more like a panic attack where volatility, moved up, and now markets are trying to settle and markets are trying to adjust. So globally, I think things are looking calm, things are looking better. Things are not looking all that uneven. But locally, we've got a lot of issues to deal with, whether it is the trail, which has been discovered on this entire PNB scam or the trade deficit data. I'm afraid locally you cannot really say it's time to be really very bullish on. So it's a toss-up today. If you go by the global setup, okay, there's reason to remain optimistic. If you only look at the local setup, flows, what's happened to mid-cap stocks, the trade deficit data, you would say, look, there's a fly in the ointment this morning once again.
The case. I mean, this morning we can't be talking about global cues, but there's nothing much to highlight except the fact that the same indicators which were worrying the markets about 10 days back. I mean, look at the 10-year bond yield. It's hit a 4-year high. Not just that, it's cruising towards the 3% marker, which is seen as a risky zone at 2.94%. Closed out flat, but treasury yields are edging higher, and that's not just for the 10-year paper. The 2-year yield, the 30-year yield, across categories, across durations, bond yields have been spiking in trade overnight. And of course, this amidst the fact that the Dow Jones has recovered considerable ground from its earlier lows. I think 8% is what it's gained after the mayhem that we witnessed last week. So that just puts the global setup in perspective. There's nothing to derail that picture this morning for our markets as we step into trade, despite the fact that the worries on inflation and rising bond yields and tightening of liquidity conditions still remains on the horizon. But Siddharth, this morning, like Nikunj flagged out, you're going to be talking about banks once again. You're going to be talking about the internal cues and more importantly, the kind of build-up the market is seeing directionally.
Tanveer, one thing is for sure that we are going to talk about banks for entire day, and for right or wrong reasons, we all know that. One liquidity cue which I want to highlight is what's happening to dollar index. Now, dollar index on closing basis is at 3.5 years low. In fact, last such low was seen on closing basis was in December 2014. Now, we all know that how the liquidity card was getting played in this up move when FI started buying. that dollar index is depreciating, US markets are going up, and hence the impact of that was seen in emerging market like ours. Whether we were underperforming or outperforming, that's a different story. But then we were going up because of that, and now we are again seeing that dollar index has started depreciating. So this is a good news from liquidity perspective. And also, if you look at the FIS data, last two trading sessions, they have not been, shorting index futures. In fact, they have been reducing their index futures positions, short index futures positions, and that's the reason last 2 days you have seen buy figures in index futures. At the same time, 10,500, now coming to the internals, 10,500 put option has seen huge accumulation of positions, and even in this entire volatile phase, you see that that level was acting as a pivotal level. That means market was not significantly deviating from that level. Now when you are approaching towards 10,600, 10,500 becomes immediate support in this market. A few large caps I want to highlight over here. Yes Bank and Axis Bank previously were adding short positions. Yesterday's move was flattish, but open interest addition is huge, which means that there would be some move over there. Needless to mention that a lot of positions got added in PNB, and those are short positions. And interestingly, one large cap name which we are not talking much of late, Hindustan Unilever, that stock has added significant open interest and seems to be long position.
Right, Siddharth. Thanks a lot for that. Well, I just want to very quickly mark some mid-cap stocks and how there has been a very, very smart recovery in some of the mid-cap stocks. And the reason why I want to mark this is that, if you really look at the decline from the top in some of the mid-cap stocks has been very large and very gut-wrenching. But the recovery again from the recent lows in India Bull Real Estate, in Fortis, has special situation stocks, yes, but that also has been very, very gratifying. So it's not that everything is lost in this kind of a market. Markets, they continue to be rather selective. You are seeing a differentiation in the market action. So the way I see, Tanveer and Aisha, is the fact that markets are right now in a mood to differentiate. The leadership in the large and the mid-cap stocks is changing, and we saw this so-called rising tide phenomenon in the last quarter of 2017, where anything and everything went up. And I think that's where I think differentiation is kicked in. So if the entire heap was going up, now there are small mid-cap stocks and sharp needles from the haystacks which are going higher. So needless to say, not everything is lost in this kind of a market, but yeah, you got to be very selective. I think time to be very, very selective is gone now. Earlier the attempt was that you buy any mid-cap stocks, you get 4-5% in a week's time. You buy small cap stocks, you were making 15-20% on a monthly basis. I guess that merry-go-round or that, as school children, we would remember this game called Ringa Ringa Roses. I think all those games have stopped now.
Yeah, till we don't sit on that roller coaster, we're okay with it. But yes, time to be selective, and that's exactly the kind of movement that you've seen with some of the mid-cap names of late. The market is really rewarding quality and punishing all the bad.